Hey everyone, welcome back to Corporate Decoder. Today we are diving into a company's recent filing with the SEC. It's a thrilling ride of financial uncertainty of a company in flux. Talk about a potential reverse split, a possible acquisition in the digital asset space to potentially make the company's value do a moonshot. If you like getting straight insights from corporate documents, make sure you're subscribed and join our Discord community linked in the description. We decode corporate jargon so you don't have to. This document is an amendment to the company registration statement filed with the Securities and Exchange Commission, or SEC. It's like the company is updating its application to sell securities. It mentions a potential $8 million offering where they'll sell units consisting of shares of their common stock and warrants, essentially giving investors a chance to buy ownership and a coupon for future ownership. Right off the bat, the filing highlights a big concern. Our financial situation creates doubt whether we will continue as a going concern. In plain English, they're saying there's a real risk they might not have enough money to keep operating for the next year without some serious changes. They've had losses and they aren't sure if they can get enough cash to cover their bills. Adding to the drama, there's a deal to sell a major part of their business, a subsidiary referred to as RYVYL EU. Essentially RYVYL Europe. This sale represents a substantial portion of our current business. There's also a clause that the company has to pay penalties if the sale cannot close on time, regardless who is at fault. Furthermore, there's the potential of entering the digital asset cryptocurrency space, but there is also no assurance whatsoever that the company will be able to do so. The report also points out a risk that has to do with people, the loss of key personnel, or the inability of replacements to quickly and successfully perform. If leading people leave, the company could seriously struggle. They also acknowledge they are in a tough business. The payments technology industry is highly competitive. Many players are fighting for market share, and some of the competitors have much deeper pockets. Another thing that they realize, our revenue projections related to our new licensing arrangements with payment services providers may not materialize due to customer acquisition and banking compliance issues that are outside of our control. Basically, they are not sure if revenues will be good, and there are a lot of outside factors involved. It's like saying, we built it, but will they come? There's also a risk their stock could get kicked off the Nasdaq stock exchange. This comes if the stock price stays too low for too long or some other listing requirements aren't met. Getting delisted would make it harder to raise money and could spook investors. Looking back at the company's history in one of their acquisitions, ChargeSavvy, around 2021, the share price at issuance was around 12. Since the current share price is around $1, since the current share price is around $1, since the current share price is around $1, so they are really down. Also, the company wrote off $18 million for a portfolio of merchant accounts because they didn't receive what was promised, a big loss. Now let's scroll to them actively pursuing steps to enhance its existing business plan. They've signed a letter of intent that's a fancy version of a "we're thinking about it" to buy another company with technology that could complement theirs. That acquisition depends, as mentioned before, among other things, on raising at least $100 million and a shareholder approval. The company transitions its Quick Card product and has some loss of revenues because of it. Now they transition from terminal-based processing to app-based processing, which didn't work out. In response to this failure that lead to losing banking compliance capabilities, there will a license of the platform, which hopefully will fix this in the long run, but probably not in the short term. All of this brings them to a point where they disclose. Without getting more funds, this cash will only be able to fund the company by the end of June in North America, which is a large part of the company. Yikes. Okay, let's try to explain this one. It appears the company made an agreement to eliminate some debt and those preferred shares and promised the security holder, someone with significant influence because the company is going to such lengths to get rid of them and their stock, to pay $17 million mix of cash and stock. But since they failed to pay the cash by the agreed date, the deal mostly failed, then paid what remained with shares, which increased the number of shares. Essentially, they kicked the can down the road on some debt, but it's still a messy situation. There will have to be a new ownership structure with RYVYL EU being sold. But in the event that the company is unable to fulfill parts of this, they won't have to pay damages. But wait, there's more. The Nasdaq has also notified the company that they're being watched since their stock price has fallen below 1,000 and can possibly get delisted if they can't get out of it by December. Delisting would make the company look much worse and turn off larger investors. Following a SEC investigation on blockchain technology, the company clarifies in simple English that their old S1 filing isn't precise and correct description of the use of Quick Card. Alright, let's get to some numbers. I'll try to simplify this as much as I can. Some numbers as of March 31 of 2025 at RYVYL in dollars cash and equivalents, 2009 PIVA in dollars, $2.9 million stockholders equity. Negative $3 million. After making some fancy adjustments they are hoping will happen, they hope their balances can look something like this after they are done with this offering of $8 million positive of stockholders equity. The company is a non-accelerated and smaller reporting company, basically a small company with less stringent reporting requirements. Now let's take a step back. Here are my overall thoughts. RYVYL is at a critical inflection point. This company has high risk and is in the process of big transitions that the potential sale of a hefty chunk of the business and talk of exploring a digital asset strategy signals more change ahead. The financial picture is undoubtedly complex, marked by a need for additional financing, high volatility, and the risk of potential delisting. This plan hinges on securing new funds and gaining shareholder support, which are far from guaranteed. In that regard, what most small business owners go through to stay afloat and have a successful business, RYVYL Inc. is going through, but on a public scale. Given these factors, any investment hinges on a positive outcome from these actions and depends on a high tolerance of risk and uncertainty. What's your take? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for more discussion. Thanks for watching. See you next time.